2.9% in November from 2.8% in October, falling short of economists' 3.1% forecast. This marks inflation's position below the central bank's 3 to 6% target band, creating room for additional rate cuts. Food and non-alcoholic beverages inflation dropped sharply to 2.3%, its lowest since December 2010, helping to moderate the overall increase. Now, the South African Reserve Bank is expected to lower the benchmark interest rate by another 25 basis points as at its January 13 meeting, expectedly following a cumulative 50 basis points reduction since September. So this morning I'm being joined by Professor Andre Roux, a professor of economics at the University of Stellenbosch Business School in South Africa. Thank you so much, Professor Roux, for joining me.
Thank you, and good morning to you and all your viewers.
Now, South Africa's inflation rose slightly to 2.9% in November, as I said earlier. Is that enough to anticipate a further rates cut?
I think it is. I mean, as you said in your summary, it came in slightly lower than market expectations. It is below 3%, which means it's way below the mid-range of 4.5%, which the governor is clearly aiming for. And I think there's more than enough levity and leeway for us to see perhaps more than one interest rate cut in the next few months. I think he will go, or they will go, the conservative route and have a number of small decreases, 25 basis points, rather one big one. But there should be scope for at least, I would say, 3 more, definitely 2, possibly even 3. Being conservative by its nature, which is a good thing, they will not want to go overboard. I mean, the governor has pointed out on a few occasions in recent times, there are still risks. The global climate is still very risky. You know, a war here, a war there, elections in America. We never know what the outcome of that might be. And also bear in mind that here in South Africa, the exchange rate, which had been remarkably firm for a number of months, has weakened slightly. So he'll be very conservative, but I think even as a conservative, he would be, or they would be, contemplating at least 3 more cuts.
Okay, so what about the decline in food and non-alcoholic beverage inflation that we saw to 2.3% in tracking? Does it have anything to do with government interventions, maybe policies, or the global trajectory?
No, I wouldn't have thought so. No, that's more just that's partly the result of the base effect. So food prices rose very rapidly until a little while ago. And you start losing momentum and how quickly things can increase. It's also probably partly a result of, as I said earlier, the firmer currency and also fairly good crops in some parts of the country. But having said that, we must always bear in mind that, as is very often the case, the poorest members of society are hit harder than the more prosperous members. So in the inflation figures that came out yesterday, we see that for decile 1, those are 10% of the poorer households in the country. The inflation is actually 3.8%. So the poorest of the poor are the ones taking the major blow when it comes to inflation. That's because food remains a big part of their basket.
And we also understand that even as households might be, most especially the ones in the lower cadre, will be the ones suffering the impact the more. We know that that would also affect smaller businesses too, SMEs, as it were. So then, how does the South African Reserve Bank plan to probably balance these rate cuts with the risks that we've seen being posed by global economic uncertainties? Part of what you mentioned, talking about fluctuation in fuel prices and a weaker rand.
Yeah. Well, as he always says, decisions are always based on current information and assumptions about the next few weeks or months. But given those assumptions, given our best sort of realistic assumptions, we are looking at global growth next year of being moderate, not exciting, but moderate, of stabilizing at a moderate level. The oil price is anybody's guess, but it does seem to me as at the moment there's actually a surplus production of oil, which always augurs well for the oil price, unless OPEC incurs quotas. Then if we have a look at the negatives for inflation here in South Africa, things such as electricity prices are set to go up quite rapidly. And if we have a look at things such as the economic growth rate, however, that came in as negative during the third quarter. Now that would justify a softening of monetary policy to try to boost the economy. But you're right, it's always a balancing act. You want to have the right combination of interest rates, given the level of economic growth, given the level of inflation. And I think for now, we could be fairly happy with the combination in terms of low inflation. We're not happy with low growth, but low growth does justify a drop in interest rates as well. We'll also bear in mind our unemployment rate remains exceptionally high. That too justifies a drop in interest rates. There's one joker in the pack, and that is the governor has been saying for quite some time that he would like to seriously consider lowering the target range. At the moment it's 3 to 6%, and that were to be lowered to, for argument's sake, 2 to 4 or 3 to 5%, then that would imply a tougher interest rate stance.
Okay.
But although he's threatening that, but it hasn't really yet come to fruition. But given our current knowledge of affairs and outlooks, I still think that at least 2 drops and possibly a third one are feasible for next year. So January, March, and May.
And you think that would also impact favorably the agri sector and the retail sector?
Yes, absolutely.
In what sense? Yeah.
It would be in their favor. It would favor most sectors of the economy, to be perfectly frank, obviously. An economy like many others that has been really struggling to grow by more than a couple of percentage points, even more than 1%, needs, probably at this stage, a relaxation of interest rates without bringing about inflationary pressures. And I think we are at that kind of sweet spot at the moment, where we could afford some further drops without raising inflation to unacceptably high levels.
Yeah, so even as we continue to see these businesses deal with inflationary pressures and interest rate hikes, though we're expecting a cut, would there be some sort of cushioning or some recourse for them to be able to expand their businesses in a way whereby we can see unemployment rates drop in the country?
Well, you see, there are a number of elements to what you're asking there. Yes, all things being equal, lower interest rates would improve the business environment, but so many other factors play a role, such as confidence. And on the positive side, the recent business confidence surveys and indeed consumer confidence surveys are showing an improvement in confidence levels. That's important. But you see, the other dimension to what you're saying there is that even though businesses might grow or new business might come online, that does still not guarantee job creation. As you know, in these modern technological days, it's perfectly possible to expand production without actually employing any more labor. So interest rates by themselves, I don't think will solve or even make a dent in our unemployment problem. There we have structural issues. The quality of labor, the skills level of labor, the productivity of labor are far more important determinants of what's going to happen to unemployment. So, but obviously lower interest rates won't be detrimental for unemployment, but probably won't make any major difference to our very high rates of unemployment.
Well, we're going to wait till January 30 next year, the MPC meetings, to see what decision will be taken. And probably some fiscal policies could also help deal with these economic issues in the country. Professor Andre Roux, Professor of Economics at the University of Stellenbosch Business School, thank you so much for your time on the show.
Thank you. Thank you very much. Goodbye.
Goodbye.